in a little bit more detail what's needed for a bottom to form in just any market.
Yeah, well, I think when we're looking at the bottom of these bear markets, again and again they keep talking about what the Federal Reserve is doing, and so we don't see the bottom of markets when the Fed is raising rates. We see the bottom of markets when the Fed is lowering rates, and this market seems to be moving really quickly based on even the rumor of that. So maybe it's just a change of rhetoric at least, or maybe even some support because we go a 0.5% increase instead of 3/4. Something has to happen in that direction to start that bottoming process to get people excited about what could happen here. So that yield curve inversion, that you're looking at here, where the 10-year is paying less than the 2-year, that probably needs to flatten out and get back to normal before you'll really start to see it. There's a lot of technical indicators we look for, moving average crossovers, different types of stretch indicators, and whatnot that you would look at to try to say, okay, this looks like a bottoming point where things are going to start to turn around. One of the biggest things for me when I really feel like things are over is when the price gets back through the 200-day moving average. Now that can be a little ways away from the bottom, but that's a really good confirming indicator over the long term in these bear markets when that price finally comes back through and accelerates upward through the 200-day moving average. That is a point to probably be 100% reinvested, and maybe you're nibbling on the way up as far as that goes, but that's a pretty good point. We almost did it. The summer rally we got within 1 point of breaking through the 200-day moving average on the S&P 500, and then that failed, and here we are again back down to the lows that we started at in the middle of June. So, yeah, it's just a matter of kind of waiting for some of these things to play out, and everybody's picking bottoms that haven't existed. I mean, somebody bought a lot of stock in Monday and Tuesday. Matter of fact, there was a rumor, or maybe not a rumor, but a story about somebody buying a massive call options on the S&P 500 on Tuesday. And obviously that means that they're betting on the market going up. That call option could have got hit pretty hard here so far, in these last couple of days. So there's people calling the bottom when there is no bottom yet, and so generally don't get one until you start to see the Federal Reserve changing their tone, at least. And it's been just the opposite. That huge run-up that we had Monday, Tuesday, all of a sudden we had 3 Fed governor interviews yesterday, all very aggressive, all talking about, raising rates, staying high for a really long time. The Fed is wrong a lot, so a lot of people want to bet against them. They were, last September they were saying they were going to raise rates at all in 2022. So now they're saying they're going to keep them up for a really long time. When something breaks, they might have to respond to that, right? Just like England did. They had to respond and start purchasing bonds to support something that looked like it was about to break, mainly the pensions there in England. So, who knows what our Fed will do.